Good afternoon, everyone, and thank you for joining us for another one of our free educational webinars with Avant-Garde Trading. This afternoon, we are happy to host Jeffrey Beamer, and he is here to talk with all of you about silent giants, time strategies for low volatility earnings. We are excited to have him here this afternoon. Jeffrey, are you with us?
I am. I'm ready to go.
Oh, wonderful. You sound nice and clear. Thank you for being so prompt. We appreciate it. You can go ahead and start sharing your screen and pull up your presentation. And while you're doing that, I will just remind everybody live here in the Zoom room, if you have questions during Jeff's presentation, please feel free to type those questions into the chat box or the Q&A box, and I'll get those over to him at the end of the presentation, time permitting, for him to address. All right, Jeff, I can see your presentation. It looks great, so feel free to get started.
Fantastic. Well, thank you for joining us, everybody. And we are going to get started. We are talking about earnings. It's a very popular subject with traders. And the great thing about trading earnings announcements are they happen every quarter. Okay. Right now, most every stock declares an earnings announcement 4 times a year. And so it's a regular cycle. And even though we're on the back side of the cycle right now, there are still opportunities out there. And so it's just something that is a catalyst. You know, you're always looking for an edge in trading, and this is no different. We're always looking for something to give us a reason to trade, and earnings is a great one. So that's what we're going to talk about today. So I'm going to throw up our own disclaimer for just enjoyment to read. I know everybody likes the fine print, so if you want to take a screenshot, or if you're watching the recording, you can pause. But we like to get this in just to let you know that we are not registered investment advisors and not giving investment advice, and please don't trade with money you cannot afford to lose. So that is the premise behind it. So let's go ahead and get started. We are going to talk today about a strategy that can be used around earnings, and we are going to specifically identify quiet stocks that don't really move around earnings. And there's a reason why we like to focus on those with this particular type of trading. Now, one thing that we'll learn about is an understanding and the impact of volatility. Now, keep in mind, there are 2 different types of volatility. One, there is something called statistical volatility or historical volatility. That's what you can see on a chart. And the other is implied volatility, and that is where it affects option prices, all right, because we are trading options around these earnings events. We're also going to then talk about creating a good option strategy to utilize around earnings. Okay, so pretty straightforward. All right, now let's get started. Now, why am I here today? Well, to give you a little bit of my background, I have been in the trading profession all my professional life. I have been in got started when I was 19 years old with 3 different security licenses. So from then on, I have got into the professional line of it after spending years at a big investment firm that is based up in the Northeast. But I have been the founder and general partner of multiple hedge funds and mutual funds, essentially investment advisory firms. I've been very active in the industry and being on the executive board and the serving as president of the Security Traders Association, specifically the Texas chapter of the STA. I've also been past chairman of the CMT Association. That is formerly the Market Technicians Association. That is the certifying body behind the Chartered Market Technicians designation. It's just like a CFP or CPA or any other professional designation. There is the CMT. And I was the chairman of the Dallas chapter, and also helped out with the Houston and Austin chapters as well during that time. So I've always been involved heavily in the markets, and specifically on the trading side of things. So with that said, let's go ahead and get started and talk about this dynamic of trading earnings. All right. So stocks don't always trend. All right. And earnings sometimes can upset a stock that is trending or a stock that is not trending. All right, that is what we are going to look for. So earnings are a popular target for option traders. Really, we're looking for two types of stocks in general. Okay, we're looking for those that are explosive, that are going to move big, and those that are quiet. And we're focusing on the ones that are quiet today. All right. So many traders, they struggle because they, pick a wrong strategy or a wrong option cycle. And that is normal, normal part of trading. Option traders are challenged with the fact that options do expire, and they expire on a regular basis. So we're going to talk about that a little bit as we go through our presentation today. So I'm going to help you seek an edge without having to pick a direction. And that's what trading is about, is seeking an edge in whatever strategy you have. And so we're going to target stocks that are unlikely to move through their earnings event. All right. Now, how do we identify these stocks? Well, there's a couple of ways. Number one is you can look at a chart. Okay. Here we have a stock called X-Ray. Well, the symbol is X-Ray. The stock is called Densply. All right. And you can see here that this stock for over a year was just trading in a $15 range. Okay. Just gradually moving up and down, really in a $10 range. Primarily, just now, within the past 2 weeks, actually, this image was taken a couple of weeks ago, and right after I took this image, the stock broke below that $27 level for the first time in over almost 2 years. All right, but even though it does, look, I'm going to circle the earnings events. And you can see that there's little gaps or a little bit of volatility around the earnings events, but realize what your scaling is of this chart. It's in $10 increments. So even though, for example, on this last circle here that you can see there's a gap down, okay, it gapped down $2. All right. And the great thing about, trading these earnings events on a stock like this these are usually more well-established companies that have been around a long time. They're well entrenched in their industry, and they don't have anything attached to them called AI. All right. So that is kind of the catalyst right now that we look for and try to avoid. Specifically. All right, we're looking for these big, well-known companies. They've been around a long time, and they're just not exciting. Okay, all right. So we spend a lot of time looking at charts and identifying when the earnings events are and how does the stock perform around earnings. Okay, and there's a reason why, and I'll bring it together here in just a few slides on why this is an important part of the 3 to 4 step process. All right. Now, identifying these quiet trade candidates begins with creating a list. All right. So you can start with a list of stocks that have upcoming earnings announcements. All right. That is a basic place to start. All right. Now, on that list, you're going to find those two types of stocks. You're going to find stocks that are historically volatile, meaning they move a lot around their earnings, and you're going to find the types that we're talking about right now, the types that are quiet and just don't move very much. All right. Now, you can create a list or find a list of stocks that are having their earnings announcement through various methods. Okay, you're sometimes, well, not sometimes, but many times, broker platforms will have that data. Okay, it'll appear either in a list form like you're seeing here, or it'll actually appear on the chart that you're looking at. It'll identify when the future earnings are. It's available also on many different software programs, different websites, like Google Finance, Yahoo Finance. It's free data, a lot of free data out there where you can find this information. So you don't necessarily have to go spend money on a fancy trading package to get this data. It is out there and is out there easily, it's easily findable. Okay, anywhere you look. All right, now one that I like to use, for example, is this is on Reddit. Okay, this is Wall Street Bets. Okay, it's free. Just you can go look it up. And in fact, what you're looking at here is they sort their earnings by market cap and options volume. Okay, so they're going to post the biggest companies that have earnings this week, and those are identified by the volume, of course, and options volume. Now, this happens to be a snapshot of this week. Now, believe it or not, there's only 97 companies that have earnings this week. Okay. And of those 97, they've identified this group here that are some of the biggest. So today, before market open, we had Carnival Cruise Lines declare. Right now, after market close, we have FedEx declaring earnings. All right. And then tomorrow morning, we have General Mills. And then we have, oh, by the way, I just looked it up. FedEx is up 15% after market. All right. So that probably would not have been a stock that we use for our list. All right. Because FedEx historically moves a lot. Okay. Different strategy for that one. All right. Okay. So tomorrow morning, we have General Mills, a couple of others, Paychex. Then tomorrow afternoon, we have Micron. Okay, BlackBerry. Wow, BlackBerry still around. Okay, Levi's, Jeffries. Jeffries is a big brokerage firm here in the industry. Then Thursday, we have McCormick's, Spice Guys. Okay, Walgreens, and then aftermarket close, we have Nike. So well-known names. Even in what this is not considered earnings season. Okay, so 97 companies in total will have earnings this week, and then next week it's even lighter because of the 4th of July. All right. Just as a reminder, the market closes early on Wednesday, the 3rd, and then we have off on the 4th, of course. And then market is regular hours on Friday. So it's kind of a broken week, and there's just not many companies that have earnings. But then, as we get towards the middle of the month, things start to fire up again, and by the end of the month, we're going to be cooking with a lot of opportunity on these earnings announcements. Okay, so you create a list of stocks that are going to have upcoming earnings, okay? And then you're going to analyze that list, and you can use a chart to analyze and look at price action around the earnings. Now, I just gave you an example with FedEx, and it's popped over 15% after market close today. So let's look at this. Sometimes here's an example of a chart that does post the future earnings. All right. And, it identifies them with a vertical line. Some will post it with a little icon at the bottom of the page. There's various methods. All right. But I can see here on this historical chart of NVIDIA, well, it looks like NVIDIA had one earnings cycle where it gapped up quite a bit, but then the next two earnings cycles that are visible here, earnings were kind of quiet for NVIDIA. And then what does the future hold, all right, for the stock? And that is where you need to assess the opportunity here. I typically use the past 1 to 2 years of announcement because those are the most relevant. And these things do cycle, meaning you're going to have periods where you're going to have very quiet performance for say 6, 7 earnings cycles, okay, well over a year. And then all of a sudden you're going to get one that pops. Okay, and that's just kind of the name of the game. They've either changed something that they're doing, or there's news of some sort, and then all of a sudden there's a little volatility around earnings. Okay, but that's how we like to use it. Or you can use indicators on your charts, okay, such as Bollinger Bands or average true range, or different tools that help assess whether a stock is quiet and is performing quietly. All right. So if I pull up a chart with both of those indicators, okay, the dotted line, the gold dotted lines that you see around price here, when they compress and they get closer together, obviously then that means we have very quiet movement in the stock, and you can use average true range if you are up to speed on that technology, and how it works and what the data means. That's something else that measures, whether you're in a trend or you're not, and is the stock quiet or not. All right. So, there's different tools, and not just these. There's all sorts of tools. I know of one that looks for stocks in a 5% channel. Okay. And others. All right. So we're looking for things with very low volatility around the earnings event specifically. That's specifically what we're looking for. All right. So, okay. Now, the fourth thing here is you can use professional tools. Okay, just like any profession, there are tools out there that will do scans and do, really, that's the hard work. Okay, you can go through hundreds of charts. When I started trading, I manually went through pages, like physical pages on pieces of paper that were printed off with a chart. Okay, and flipping through looking for different patterns on hundreds of stocks that we were trying to analyze. Okay, and then computers came along and made that process a lot easier. And that's one of the advantages today, is even on some of the most basic packages that are free, okay, you have tools that you can use that can help really make this process a lot easier. And you can take days and weeks worth of work and compress it down into just minutes, okay, with the help of tools. Okay, so there's free ways to do it, and then there's professional tools to help do it. But in the end, it's all the same. Okay, so we talked about checking volatility, and specifically what we just looked at was statistical volatility. Okay, now we're going to check a different type of volatility, and this is called implied volatility. All right, now there's lots of little lines here. Don't worry about all the little lines. They're very easy to understand. Okay, the different colors represent different time periods is all. I want you to focus on the red line. Okay, the red line is the 7 to 30 day at the money implied volatility for a particular stock. In this case, it's Zoom. Okay, ZM is the symbol here. All right, but notice what happens every quarter around earnings. You get a surge in implied volatility. Now, the reason this is important is because that surge in implied volatility affects the option prices. Okay, and it makes options more expensive, because there's an upcoming announcement. They're unsure of the outcome. That unknown causes implied volatility to rise, and options become more expensive. But then, magically, like right after the announcement, look what happens. We have this is called a crush. This is called IV crush, when that red line drops down violently and compresses and gets back down to normal, just like a rubber band. You're stretching a rubber band and you let it go and it snaps back. That's what's happening here. Okay, around that announcement, the announcement gets made and boom, snap back it goes. That is volatility crush. And that's what takes your very expensive options to make them very inexpensive options. All right, so part of the process here is that we sell the expensive options and we buy it back at a cheaper rate. Okay, so you can sell to open expensive options and buy them back after the IV crush has occurred, and they're often much less expensive, okay, at the time. Now, there's some other factors. We're going to talk about the other factors here in just a moment. Okay, now a strategy that is really good for this is called an iron condor. Now, if you are familiar with this strategy, before you roll your eyes, let me talk to you about it. And those of you that aren't familiar with the strategy, we're going to dissect it here real quick, okay, and kind of bring everybody up to the same page. Okay, but there's a reason we use this type of strategy. Okay, and I'm going to go over some of those reasons for you right now. Okay, so the review is for those of you not familiar with the strategy, it combines two vertical spreads together. Okay, a bull put spread and a bear call spread, two vertical spreads. We're selling the put spread and we're selling the call spread. Okay, selling both of those, but we're combining them together, meaning we're doing them at the same time with the same expiration date. Okay, all right, so you combine that bull put spread and that bear call spread together. The two credit spreads, because we're taking in premium when we sell the put spread, and we're also taking in premium when we sell the call spread, that creates a larger credit than one. And there's a unique advantage to trading this type of strategy when it comes to margin. Okay. The goal is to generate income through the premiums received while minimizing risk through the purchased options. All right. Now I'm going to show you a visual of this in just a second. All right. I'm a visual person. You know, I begin to understand things when I see them visually, and we're going to do that together here. So this strategy will make a profit if the underlying asset remains within a certain price range after the earnings event and up until expiration, or it'll incur a loss if the asset moves outside of the range. And the range is represented by what we call break evens. Okay, there is an upper break even and a lower break even, and as long as price stays within those ranges, we're going to benefit. We'll be able to make money on that trade. Okay, so let's talk about this a little bit. First diagram here on what we call a risk chart is a long put. Okay, so you're buying a put, and then we sell a higher strike put. Okay, these are the two individual risk graphs. Okay, buying a long put and then selling a higher strike put, that would be done at a credit. Okay, then the risk graph looks like this. Okay, if you did it $5 wide and you took in $1, then your maximum profit would be that dollar, and you're risking the width of the spread minus your credit. So that would be the $4. Okay, so you have $4 risk. Now you might be asking yourself already, why on earth would I do this? Why on earth would I risk more than what I can make? And the reason is probabilities. Okay, it gets down to probabilities. All right, when you do something that is that has lower risk and can make more profit, that is usually out of the money, and your odds are reduced. Okay, because you don't know if the stock is going to go up or down. So you know you have certain odds here. Here the odds are a little better because of we're not only already in the money, or we're in the profit zone, but we think it's going to stay within the profit zone, and that gives us an edge. Okay, now on the call side, it's just the reverse. Okay, now first we're going to we're going to buy a long-term call. So let's get that risk graph in there. There we go. And then we sell a short, we're going to buy a short-term call, and then we're going to sell a short-term call. We're going to do these pretty close to expiration. Okay. So I don't want the lingo of long-term call to get, to interfere here. We're doing these pretty close to expiration and pretty close to the earnings announcement. Okay, so here we're going to buy a call, and then we're going to sell a lower strike call. That's what I'm trying to say here. All right, so in this case, we're buying the 55 strike call, then we're going to sell the 50 strike call. Notice if it's $5 wide. Okay, and so same scenario here is if we are able to sell that spread for $1, our max risk is $4. Okay, because it's the width of the spread is your max risk. That's $5 minus the credit you receive, which is $1. You're left with a max risk in the trade of $4. Now, here is the interesting thing. When we graph this out as, the trade, okay, combining the bull put spread with the bear call spread, we combine these together, okay? Here's an interesting thing that happens. That maximum risk gets reduced because now we have the two spreads combined together. So we're combining both credits. So now we're taking in $1 from the put spread and $1 from the call spread, and our profit is $2, and our risk gets reduced to 3. Now, here's the thing. If you're thinking, wait a minute, I have $4 risk in the put spread and $4 risk in the call spread, that should be $8. Well, the OCC, which is the Option Clearing Corporation, they're pretty smart guys, and they realize that hey, the stock can't be in two places at once. So when it comes to margin, we're only charging you one margin. As long as your strikes are equal width apart, meaning in this example, they're $5 wide on both the put spread and the call spread, all right, your maximum risk is only going to be that $5. Okay, so in this case, we get the advantage of taking in the additional premium, but we don't have the added margin. It is only one margin because the stock can't be in two places at the same time. All right, it can't be below our lower strike and then be above our upper strike or upper break even at the same time. It's going to be one or the other. Okay, it's either going to be in the profit zone or below our lower break even, or in the profit zone and above our upper break even. It's pretty straightforward. Okay, so now the dynamics change a little bit. Better reward, better to risk ratio. We've reduced the risk down, we get a bigger premium. So now you can see that we do have break evens in the trade, and that's what I was kind of talking about earlier. What we're looking for here is for the stock. Sorry, let me go back to that. We're looking for the stock to stay within that pink profit zone. Okay, so we can, if it's between 45, in this example, if it's between $45 and $50 and it stays there, we get maximum reward, or pretty darn close to maximum reward in the trade. However, if it starts dropping below 45 and starts dropping above, moving above $50, our profit is reduced, and then it is eliminated if it gets to the break even of $52 on the high side or $43 in this example on the low side. And if it's below either of those, if it's below $43, then I have a loss. And if it's above $52, then I have a loss. But herein lies the benefit. If I've got a quiet stock that's just not moving, the odds are it's probably not going to move through this earnings cycle as well. And this is a very valid strategy for that. All right. So this is where we get the advantage of selling the high implied volatility that we saw on that Zoom risk graph, the IV graph on Zoom just a few minutes ago. We get to sell that premium, take in that credit, and then right after earnings, that IV crush happens, and we get almost instant profit if it stays between our break evens of the trade. Okay. All right. So the best setup here. Options expiration, somewhere between 15 and 45 days. Okay. The great thing about this is that not only are you going to be trading expensive options, but you have time decay. Okay. Every day you're in the trade, these options decay in value, which is okay because we sold them. Okay. We sold them. Well, we sold the body. Okay. The long options, remember, the long options that we have on either side, those are just to hedge our position. We're not trying to profit on those. Their only purpose is to reduce the margin on our trade. Okay. Is to reduce the cost or increase the buying power. All right. If I were to sell a call and sell a put and just not buy anything, not only would that be unnecessary, my buying power reduction would be enormous. Okay, the margin that they would want to hold that type of position naked would be, I've got better places to use money. Okay, so that's what those legs are for, is just as a hedge. Okay, their only purpose is to reduce that margin. Okay, so we want implied volatility to usually be between medium to high. Now, I divide implied volatility into thirds. Okay, the scale is 0 to 100. And as long as you're below 33%, that's low implied volatility. If you're between 33 and 66, then that is medium. And then if you're above 66, that's high. Okay, very simple. Okay, so the great thing about earnings is that you almost are guaranteed, and that's a very, I can't believe that word actually came out of my mouth, because we're not, that's not a word that we use, but implied volatility is going to be higher than it has been in the past for those near-term options. Okay, for those 7 to 30 options that expire in 7 to 30 days, their average is going to be medium to high. They're going to be in of the one, we call it the 1-year rank. It's a 1-year look back, and it's going to be in the upper levels of that 1-year rank, because of that upcoming earnings announcement. Okay, we're also going to look at the chart and make sure that the price just doesn't move around earnings, and that it stays relatively low. And typically, I don't really worry about delta too much, but usually these are delta neutral, meaning there's no to very little deltas in the position. A delta of 1 is like 1 share of stock. A delta of 7 is like 7 shares of stock. That's usually where we are, either positive or negative around that. It's hard to get it perfectly at 0, but so you're always going to have a little bit of positive or a little bit of negative. All right. Gamma, of course, and we're talking about the Greeks here. It's less important at the setup, but is more important later in the trade, after the announcement, if you end up staying in the trade. Okay, and I'll show you some examples of that in just a second. All right, so again, we're talking about here on this slide 2 of the Greeks. Okay, we've already been talking about implied volatility, which is the third Greek, and we also talked about theta decay, which is another Greek. So we really touched on most all the Greeks. The only Greek we haven't really talked about is rho, and that rho takes in interest rates, which historically hasn't been a factor until now. Kind of recently, we do have, with higher interest rates, rho's becoming, it's not really affecting much yet, but if rates continue to rise, then you'd start hearing about rho, RHO, quite a bit more. All right. Now, building this is pretty simple. Okay, remember, it's a bull put spread and a bear call spread combined together. So when you go to your broker's site, it's going to look something like this. Calls on the left, puts on the right if you have it set up vertically. Okay, strike prices in the middle, and we can go out and say, and I always start with my buy sides. Okay, sometimes the slide doesn't behave and it will put the sell up first, but I always, out of habit, start with the buy. Okay, we're going to buy this and we're going to sell that. So in this example, we're doing a $4 wide spread there. Okay, we're buying the 56 and we're selling the 52 calls. All right. Now, we're also going to buy a put. In this case, in this example, we're buying the 44 strike puts, and then we're looking to sell the 48s. All right, there's your bull put spread. All right, so buying the 44, sell the 48, buying the 56, selling the 52. Okay, so one way also to look at it is you are selling the strangle. Okay, the strangle is essentially selling 2 different strikes. So we're selling the 48s and selling the 52s, and then we go out and we buy the wings. Okay, we're buying the 44s and buying the 56s, and that's just to hedge the position. Okay, is to keep my risk at $4 minus my credit. Okay, that is what the purpose of that is. Okay, now some other considerations here. Strike placement is key, with the objective of being that the stock price at expiration ends up being between the 2 middle strikes. All right. the effects of time decay will help increase profit over time, but we are going to be placing these, like if you're doing 15 days or maybe even less, you can do less than 15 days, just putting that out there. Time decay is really going to be on your side, okay? And you're going to get double advantage of an upcoming IV crush in the options and of time decay. You got two things working for you that often work against traders, okay? The effect of implied volatility is the biggest contributor to profit, and that is true. As IV crush occurs after the earnings, and option premium drops. And I've talked about it, and I'll show you this in just a second, okay? Let me go back up to that first bullet for a moment. Strike placement is key with the objective of being that the stock price ends up between the two middle strikes. Okay, let me tell you something. When you look at the option prices and you combine that with the historical move of the stock, now I will say software makes this easier, but you can calculate it on your own. What I mean by that is you can use FedEx as an example. If you were to go and look at what the market makers were pricing, what happens is market makers price options for the expected move through the earnings announcement, okay? Now, I don't know this for a fact, but I'm going to use it as an example, just to be very clear. Let's say that the market makers thought that FedEx, which again is up 15% after market close today, but they were pricing for a 20% move. And there's a formula. These days you can probably Google it, okay? But there's a formula that market makers use to estimate the move, okay? And let's say they were pricing in a 20% move. And then earnings come out and FedEx only moved 15%. Well, guess what? For us, trying to, doing this type of strategy, that's great because we were selling premium, 20% out of the money because that's where the market makers, were kind of pricing it, but then the stock only moved 15%. In reality, it's going to be a little lower than that. Market makers might say, hey, we estimate a 6% move, and you're priced for that, and then you do your trade and the stock only moves 3% or less. That is the edge that we're talking about, okay? So it works on stocks. Just because the stock is up 15% after market doesn't mean this strategy would not have worked. It all has to do with what the market makers were pricing the options at, and were we able to get off a good trade around that, okay? But that's just something to note there. A little bonus information that was right there. So let me show you some trade examples, okay? So we run a service. We put this out to our service. So you're going to see things like the trade ID, okay, an iron condor. This was on Home Depot, okay? This was on May 9th, okay? So just 2 months ago, okay? Notice what you want to look at here is really the black line shows you the at expiration. On the right-hand side here, the black line, the risk graph, shows the at expiration. The red line represents today, okay? The red line represents today. And the horizontal blue line, notice it touches price here on the last day of price, okay? And then it streaks into the risk graph, and it dissects the red line. The red line is touching the zero line. Okay, so we put on the trade. We're starting at zero, right? We took in a credit. So how much did we take in? We took in 66 cents per spread. Okay, so we did 2 contracts, took in $1.32. All right, now think about this for a second. Why did we only do 2 contracts? Well, again, it's money management. The boring part of trading, okay? Money management. Hypothetically, we're using an example hypothetically of a $10,000 trading account, okay? So, what's my margin going to be? Well, we got to figure out what our spreads are and what the trade is. Okay. But I can tell you it was $4. Well, it was $5 wide. So, we took in $1.32. So then we're going to be risking, the difference, what, 378 or whatever it works out to be there. Okay. Now, what we're planning for here is for Home Depot, okay, to go through their earnings and the stock to stay within this range. And you can see here the upper break even is above, just above 366. It's like 367, and the lower break even down here is around 324, 323. Okay, so then we go into earnings. Look at that. Stock dropped, rallied back up, and then we waited a day, and look at that. It gapped up. All right. And then look where the blue line is, and look where the red line is. Pinned to the max profit of the trade. Pinned to the max profit of the trade. Let me go back. You go from here, and then a few days later, let's see here. We go from the 9th to the 15th. Okay. 9th to the 15th. And look at that crush where that red line just rushes in and says, oh, take your profits. We were able to buy back or close the position for $1. Okay. For $1. And then that generates a profit of $1.31. Okay. $131. Now you're thinking, $131? Well, that's no big deal. Well, let me tell you, that is a 1.31% return on portfolio in just less than a week. Okay. How many stocks have earnings during earnings season? Well, I can tell you there are hundreds during the heart of earnings season. There'll be over 1,000 stocks a week having earnings. No joke, no joke. And you can see that even no matter where you look. But I mean, literally, I'll see. Oh, this week we have 1,400 stocks declaring earnings. Not this week, but in the future. Okay, in the future. So it's one thing to be aware of. Now, if the stock had gapped up above 366 or 367, we slide down that black line, and that is gamma. Okay, that is gamma. Sliding down these risk curves. That's gamma. That's the effect of gamma, and you start losing your profit. Okay. Well, here we experienced almost our entire profit. So the prudent thing was to exit the trade and take the money, take the profits, and move on. Okay. Now let's look at another one. This was an iron condor on Advanced Auto Parts. This was done on May 24th. Okay. Had upcoming earnings. And look at the width of this one. This one's $20 wide. We sold the 80s, bought the sold the 60s. Okay. Sold the 80s, sold the 60s, it looks like we bought the 85s and bought the 55s. All right. So same thing, $5 wide spread, but $20 apart. Okay. Because Advanced Auto Parts tends to move a little bit. But guess what? Market makers were pricing in a move, and historically, we didn't see that move happening. Okay. They were expecting for something bigger than what really was historically happening with this particular stock. So on the 24th of May, we entered a trade. It was a $1.20 credit. We just did one contract, $120. That means our max risk in the position was $3.80. All right. $3.80 is what we're risking. So we're looking for the probabilities, and look at this, boom, a little bit of volatility. Sure enough, the stock dropped, traded lower, and then around 11 a.m. started rallying and rallied the rest of the day. Guess what happened to IV? Implied volatility crushed. All right, let's look at that again. You go from the red line that is touching the zero line, and then overnight, literally, IV drops, and boom, even though the stock moves, we were able to exit this for $3. We sold it for $120. Okay. Bought it back for $3. That's profit right there. In fact, that's a profit of $117. Okay, that's a 1.17% return on portfolio. If you did these back to back, then you'd be looking at about a 2.5% return on portfolio in 2 weeks. Annualize that out. Okay, except we're doing a lot more, okay, than these, and you can do a lot more of these at the same time. Okay, and because some of them won't work. All right, and what you're trying to do is minimize your losses and maximize your returns on the ones that do work. Okay, and it is sometimes your break evens will be tested, and you just gotta realize that you might have a break even trade, you might even have a loss. Okay, but it's all about averages, and I'm showing you two in a row that were winners, and we're looking at that cycle to continue. Okay, we got some on right now that are haven't had their earnings yet, and remember, there were names on that list that this week have earnings, and we're doing the same thing. So if you have questions about anything I covered, please feel free and type them in or ask them. I want to give you a gift for attending. We have a free download for you that will cover pretty much what I covered today. In fact, not pretty much, it does cover what I covered today. Okay, it's trading this strategy around earnings, and it's something that you can get to review. And let me just double check and make sure that we're all good to go there.
Yeah, thank you so much, Jeff. That looks great. And I know if you also can put up any sort of like a contact email or anything in case people have follow-up questions. Perfect.
Sure
that way,
can do that. Yeah.
Wonderful. Because what happens more often than not, Jeff, is everyone, we listen to these amazing presentations and you're taking it all in, and then inevitably, midnight tonight, someone thinks, oh, I have a question about that, or oh, this, I just remembered what I wanted to ask. So it's good. I want to encourage you all to write down that email and phone number, and then feel free to reach out to Jeff directly with any follow-up questions regarding what he presented this afternoon. Thank you so much for putting that up there. Yeah. And I want to leave this up here just for a minute again, so everyone can write down that contact. And if you guys don't have the opportunity to screenshot this or write it down, don't worry. As I said, we'll send out the recording tomorrow, so it'll have Jeff's contact info at the end of the recording as well, in case you need to access that. Okay.
Yep.
I'm going to go ahead and take screen control back because we are wrapping up. We're pushing right up against our time frame here. I just want to give everyone one last opportunity. If you do have a last minute question, please type it in the chat box or the Q&A. We can ask Jeff right now. We did have one question coming in, Jeff. I don't know if you can kind of give like a generalized answer. The caveat being, of course, this depends on the individual and everyone's risk parameters and everything. But was there a specific sort of time frame? The question asked for when you're putting on that initial entry signal to when you exit. It seemed like in the examples you showed, it tended to vary. Was there like a general guideline that you go by?
Sure. And it really deals with where you are in the week, in the trading week. For example, if I'm looking at a stock, can I give a specific example? I mean, some specific guidelines, not stocks, but guidelines on that?
Sure. Yeah.
Okay. All right. So if I'm looking at a stock and it's a Tuesday and they have earnings even tomorrow, okay, I know that implied volatility is going to be really high, and I will do that trade. Okay. I will do a 1-day trade with these. If all the numbers are right. Okay. If it's a Thursday or Friday and the earnings aren't until next Wednesday or Thursday, I'll go ahead and do it on a Thursday or Friday and make it like a 5-day trade, because I got the weekend. And we all should know what happens over the weekend. We get theta decay over the weekend. And so this is benefiting our trade. And then we get into the next week. Usually there's a tick adjustment in implied volatility that happens right before the earnings. Sometimes it's down, sometimes it's up. It can either help us or hurt us, but then we get the announcement and boom, right, we're on the right side of this. We try to be more right than wrong, of course, but those are the time
Right.
frames. So yes, if you were looking at a window of when we do these, we're taking them right up to, it could be 10 days, it could be 1 day, it could be 50, it really could
Okay.
be 15. It depends on pricing and where the options are. And but it's you're usually taking this off within 1 to 2 days after the earnings event, because IV has crushed and there's no sense in staying in the trade because you got so much of your profit already. That's the long-winded answer to your simple question.
Yeah. No, not a simple question. Thank you. Appreciate that. Yeah, that was one of the questions we had coming in. And I just want to remind everybody to please reach out again to Jeff directly if you have any additional questions about the presentation. Reach out to us over here at Avant-Garde with any questions about our educational webinars. Please keep your eye out for invites to our next upcoming webinars. We have another one next month as well. And Jeff, always a pleasure having you. I definitely want to have you back to talk to us about another options trading topic whenever you're
Awesome.
able.
Awesome. Great.
Fantastic.
Well, thanks for having me.
Thank you
Enjoyed
so
being
much.
here. Hmm.
It was wonderful to have you. Thank you again for everything. And thank you for everyone who took time out of their schedule to join us live and to ask that question. We appreciate it. Have a good rest of your day and good trading to all.